Volatility. It's the heartbeat of the market, a double-edged sword that can bring both exhilarating profits and gut-wrenching losses. For some traders, it's a source of anxiety, a force to be avoided. But for those who understand its nuances, volatility presents an opportunity, a chance to capitalize on the market's swings and reap substantial rewards. Think of CPI and FOMC days. These are not just dates on the calendar, they are potential volatility explosions waiting to happen. The release of economic data like CPI or a policy announcement from the FOMC can send shockwaves through the market. Indices like the S&P 500 and NASDAQ can experience dramatic price swings in a matter of minutes. But here's the key. These events are not random, they follow patterns. By understanding the forces at play and employing the right strategies, you can learn to anticipate these moves, manage your risk, and even profit from the chaos. This essay serves as your guide to navigating the turbulent waters of high volatility trading, focusing on CPI and FOMC days. We'll equip you with the knowledge and tools to approach these events with confidence, turning potential fear into strategic advantage. Imagine this. You're glued to your screen. The clock is ticking down to the release of the CPI data. The air crackles with anticipation. Traders around the world hold their breath, knowing that what happens in the next few minutes could make or break their day. This is the reality of CPI Day, a day that can make or break trading accounts. The CPI is a key measure of inflation. It reflects changes in the prices of goods and services. When the CPI is higher than expected, it suggests rising inflation, which can lead to a sell-off in the stock market. Why? Because high inflation erodes the value of future earnings, making stocks less attractive to investors. Conversely, a lower than expected CPI can signal slowing inflation, potentially boosting the market. Investors cheer the prospect of stable prices and a healthy economy, driving up stock prices. This back and forth, this push and pull between fear and greed, is what creates the volatility that savvy traders thrive on. However, CPI Day is not for the faint of heart. The market's reaction can be swift and unpredictable. It requires a cool head, a well-defined strategy, and the discipline to stick to your plan. So how do you navigate the choppy waters of CPI Day? The key lies in preparation and a deep understanding of how the market reacts to different scenarios. Let's break down some effective strategies. First, know your levels. Before the CPI data is released, identify key support and resistance levels for the indices you're trading. These levels act as potential turning points for price movements. Support is a price level where buying interest is strong enough to potentially stop a decline. Resistance is the opposite, a price level where selling pressure could halt a rally. Second, scalping the release. This high-risk, high-reward strategy involves placing quick trades immediately after the CPI data is released. The goal is to capitalize on the initial volatility and capture a small profit from the rapid price swings. This strategy requires lightning-fast reflexes and a strong understanding of order execution. Third, fading the move. This strategy is all about going against the initial reaction. If the market overreacts to the CPI data, fading the move means taking a position in the opposite direction. For example, if the market sells off sharply on a higher than expected CPI, a fade trader might look for an opportunity to buy at a discount, anticipating a potential bounce. Fourth, news-based options trading. For experienced options traders, CPI Day presents opportunities to profit from increased volatility. Buying straddles or strangles, for example, can be a way to capitalize on large price swings regardless of the direction. Remember, every strategy has its own risks and rewards. The key is to choose a strategy that aligns with your risk tolerance, trading style, and market outlook. Section 4. The FOMC Puzzle. Deciphering the Fed's moves. Twice a quarter, the financial world turns its attention to the Federal Reserve. Why? Because the Federal Open Market Committee, or FOMC, holds a meeting that has the power to move markets with a single announcement. These meetings are not just about dry economic data, they are about the future direction of the U.S. economy. The FOMC's primary tool for influencing the economy is the federal funds rate, the interest rate that banks charge each other for overnight loans. By adjusting this rate, the Fed can influence borrowing costs for businesses and consumers, ultimately impacting economic activity and inflation. Traders eagerly anticipate the FOMC's policy statement and the subsequent press conference by the Fed chair. They dissect every word, every phrase, looking for clues about the future path of interest rates and the overall health of the economy. A hawkish tone suggesting higher rates can send shivers through the market, while a dovish stance favoring lower rates can spark a rally. Understanding the FOMC's language is like learning a new language. It's about interpreting subtle cues, reading between the lines, and anticipating the Fed's next move. This is no easy task, but for those who master it, the rewards can be significant. Section 5 FOMC Day Strategies Navigating the Storm. FOMC Day is not the time to be complacent. The market can react violently to the Fed's announcements, creating opportunities for those prepared to navigate the volatility. Here are some strategies to consider. 1. Pre-FOMC positioning. Some traders prefer to position themselves ahead of the announcement based on their expectations of the Fed's actions. This strategy involves analyzing economic data, Fed speeches, and market sentiment to predict the likely outcome of the meeting. 2. The fade the rumor, buy the news approach. This classic trading adage suggests that the market often overreacts to rumors and speculation in the lead-up to an event. Traders employing this strategy might look to buy after a significant sell-off if the FOMC announcement is less hawkish than feared. 3. Volatility trading with options. Similar to CPI Day, FOMC Day presents opportunities for options traders to profit from increased volatility. Buying straddles or strangles can be a way to capitalize on large price swings regardless of the direction. 4. Focus on the press conference. The press conference following the FOMC statement can be just as important as the statement itself. Pay close attention to the Fed chair's tone and language. Look for any hints about future policy decisions. Remember, trading around FOMC announcements is not about predicting the future with certainty. It's about understanding the potential scenarios, managing your risk, and capitalizing on the opportunities that volatility creates.